and welcome to Front Funders Ask the Experts, our monthly deep dive into a specific topic from the world of investing. Along with industry experts, we take a thorough look at the topic, how it relates to what's going on in the world right now, and also answer any questions that you might have. Our theme for today is investing in Canadian real estate, which I'm sure is a theme that you all know plenty about, be it the ever increasingly unaffordable cost of housing, the billions spent every year by speculators on land and entry-level acquisitions, or perhaps more recently, the effects of the pandemic, such as the rise of remote working and the move away from urban centers. But to untangle all of this over the next 30 minutes, I'm delighted to say that I'm joined by an all-star panel that includes Mike Hibberd, co-founder and chief compliance officer at Willow. Hey, Mike.
Hi, everybody.
Marcus Cran, who works in investor relations at Westbow Capital. Welcome, Marcus.
Thanks, John. Thanks for having me on today. And yeah, thanks for everyone joining.
Awesome. And co-founder and CEO of Manzil, Mohammed Sawaf. Welcome, Mohammed.
Thanks for having me, John, and happy to be with the panelists here and looking forward to a great session.
Awesome. A very warm welcome to all three of you. And a reminder to everyone tuning in today to please submit your questions throughout the session for the panel, and we'll cover them as we go. I'd like to get started with a little bit of an overview on investing in the real estate space. So my first question is directed towards you, Marcus, and I'd like to ask you that, talking about real estate in general and what makes it an attractive investment opportunity, why is this something that everyone talks about and in some way everyone's aware of it and knows a little bit what's going on?
Yeah, no, a great question to kind of start off to get the overview. I mean, it's something that everybody kind of understands to a fundamental level. I mean, everybody's got to have a roof over their head. They're living, they're paying their rent, or they got an office space. Like, real estate is everywhere. It's not just like this, thing that nobody understands. It's like, and then most people kind of have that somebody in their family or, a cousin, a friend or whatever, that's like, oh, I made it huge money in real estate. You can too. You know what I mean? Like, everybody has that tie to it, and there's kind of got that lure to, like, it's an attractive place to be. So everyone kind of wants to know a little bit about it and think they can dabble in it. So, I mean, the main drivers, like why I see real estate as being such a great place to be, a great investment opportunity, is because there's so many different drivers of the returns on how you're actually getting a return in real estate. So, first off, you're basically, when you're buying a property, and I'm going to preface this as, I kind of dabble in we're in the multifamily, we're in the residential real estate space. So, I mean, there's different asset classes. These kind of returns apply to the different asset classes, but kind of preface that focusing on the residential side. So first off, you're buying a property, you're typically getting a mortgage in place, and you're putting a tenant to, when you're renting it out as an investment, they're in place to actually pay you rent as a landlord. And then that allows you to go pay the mortgage. So right off the bat, you're reducing your debt by you're buying a property with that. And then when you go and sell it, say a year, 2 years, 5 years, 20 years later, you've then either paid off a good chunk of the mortgage. Now you have a higher equity position in the property. Now that equity is basically cash in your pocket when you go and sell the property and realize that gain. So that's one of the first drivers. Second is you're getting cash flow, right? Well, if you buy it right in the right market and whatnot, but essentially same concept. You're buying that, you're putting a tenant in place. And if you're getting rent income in excess of what your expenses are, including your mortgage, that net cash flow at the end of the day is money in your pocket that you're getting, basically residual, or people like to call it passive income, on a monthly basis, because that's when rent is due, right? So a great aspect is really complementing your income through the cash flow. The next kind of hot button, return driver is going to be the appreciation, which is everybody's like, gets excited about that. And that's what I kind of see as the bonus. If you're buying for strictly the cash flow and the debt reduction, that's a great return right away. But the appreciation is kind of the icing on top. It's on top of the cake, because I mean, when you kind of buy in the right place and you look at the fundamental factors of the market, and people are moving into the area, there's job growth and employment growth and population growth, that's typically going to lead to the property going up in value over time. So just holding it for a couple of years, 5-10 years, like you can start seeing growth. And I know like I'm in the BC market. John, I think you're out in the Toronto area, but I mean, these are places, cities that have seen substantial growth and appreciation. So just by holding a property over time, you can see growth in the value of a property, which you can realize when you sell it. It's especially a great way to kind of protect against inflation as our cash or our money gets devalued as the government keeps printing money, especially during this time, during the pandemic. So it's, I like to call it an inflation hedge, because as our dollars become less valuable, well, fixed assets like real estate typically go up in value, increasing at a rate faster than inflation. Historically, at least, I mean, over the last 15 years, it's gone, increased at about 6.08% appreciation rate over the last 15 years in Canada. So kind of use that historical numbers as kind of guidance on what kind of like appreciation you can get. And it'll vary by market to market. And last kind of thing here, and I can go on detail. I want to pass it off to some of the others on the panel here as well. But last thing that people often don't even know about such a great return driver on real estate is the tax benefits. And that's kind of why you hear like the concepts of like, a Donald Trump or something like that, who's made, multi-millionaire, probably, I don't know, billionaire, and he's paying so little in taxes over his career because he's had a large amount of money in real estate. And there's so many benefits because when you're buying real estate and a building, it'll depreciate over time. It only has a useful life over a certain amount of time. That allows you to take what's called depreciation, a depreciation expense, or in Canada, you'll call it a capital cost allowance, that basically allows you to write it off over time. And that can then be applied against your taxable income. So you can basically be receiving cash flow in some cases where you're not even getting taxed on it, because you'll be receiving positive income or cash flow or profit, and your financial statements for tax purposes will show that you're operating at a loss because you're taking this depreciation expense, which you're not paying money out of pocket for, which allows you to basically take these write-offs and reduce your taxable income. So you're getting, huge after tax or net returns after tax. And that's a huge thing that people often miss in this whole real estate investing world. So, or at least kind of beginners who don't know the ins and outs of it. So that's kind of why I see as real estate as being so attractive.
Oh, definitely. I think you covered all the main points really well there, and clearly it is a very attractive investment opportunity. I'd like to kind of chuck the next question over to Mike and sort of focus it a little bit more on Canada. So that's real estate investment as a whole. What would you say, Mike? Is there a difference between investing in Canadian real estate as opposed to US real estate or European? What are the differences, and where does Canada stack up against those other options?
Certainly within Canada, it's a very stable market. That was sort of the one thing I'd maybe add on to what Marcus was saying about the real estate landscape is very stable. A lot of Canada's economy is, integrated with our real estate economy. There's a lot of government measures to ensure that we have that stability. I can't speak to, certainly Canada is looked to as one of the stable markets. It's been flagged in the past for, particularly some of our hot markets with lofty prices. But we do have government measures in place. We've been tested through lots of economic downturns, like the 2008 financial crisis probably being the biggest one that stands out. And, Canadian real estate held up really well. It's held up, on the whole really well through COVID as well. So I'd say it certainly has stability. And then as far as like Canada as an economy, very stable as well. So I'd say like stability and long-term growth bodes very well for Canadian real estate. I can't speak to like I said, all of the alternatives out there internationally. There's going to be a lot of comparables. There's going to be other markets that have similar level of stability. I'd say Canada's likely right towards the top. Other markets may have be a little bit more speculative with high growth like opportunities. That's sort of how I see it.
No, definitely.
Something to tack onto that is like we kind of track. I mean, I don't know, Mike, if you're too much in the residential side of things, but we're looking at like vacancy rates comparing between Canada, the US. Like we've actually found over the last, I think it was since 2000, we're tracking vacancy rates, and the average in Canada for residential was about 2.7% over that time. In the States, which is not to say that it's a bad market. It's still a phenomenal market, but we just kind of look at, little micro trends and things like that. But like vacancy rates over that same time period kind of averaged over 8%. So, I mean, that was kind of a telling sign that was like, okay, speaking to Mike's point about the stability there, and there was no major, spikes or anything like that during the '08 recession for vacancy rates. So yeah, another interesting kind of fact there.
Yeah, I think that's a really sort of pertinent point, as you say, the vacancy or the occupancy rate, and then also as Mike said, kind of when you're looking at an investment, stability and resilience are kind of things that you really want, especially over the long term. So it's definitely there. Mohammed, how would you rate real estate investing compared to other types of investment? I'm thinking of fintech or green investing or anything else. How do you see it stacking up against those different types of areas?
So we're in the space of Islamic finance. So anything that we look at as an investment opportunity, our preference is an asset-backed or asset-based type transaction. And so real estate really fits in nicely. And we don't have a bias towards real estate, but because it's an asset class that a transaction can be conducted within the principles of Islamic finance. Long term, I always like to caution people that there is some sort of recency bias with respect to the growth of real estate, especially in kind of the major markets here in Canada. And we only really have 3 or 4 major markets, right? So it's like Toronto, Vancouver, Montreal, and maybe like, I don't know, maybe a Calgary, maybe in Ottawa, maybe it's a London now, right? So Southwestern Ontario. Whereas you look at the US, they have like 80 major markets when it comes to real estate. And so when you look at just the fact that, we're in a low interest rate environment, and that encourages usually price increases because the affordability becomes, you can afford more house with the same dollars, even though the government has put in all these measures. It seems to be a really resilient asset class. And so, you look at 2008 and you look at this pandemic and how real estate has kind of, handled this downturn. It becomes pretty easy to look at. Whereas, other, asset classes like fintech or even green tech, I think is quite encouraging these days, just because now we're hearing this whole bit about solar being cheaper than fossil fuels, right? Like it's now kind of reached that critical peak that it is, from a price perspective, a lot cheaper. So I think there is long-term growth there in that asset class. Fintech, it's funny because you had a lot of fintech activity, not only here in Canada but globally. And when the way these VCs price these fintechs, it's usually on $1,000 lifetime value per client basis, right? So you got 10,000 clients on your platform, you're worth about $10 million in terms of valuation cap. And I think what's missing is, how do you increase the value on a per client basis from that fintech, right? So maybe it's, doing, via economies of scope, like increasing your product shelf, being able to generate more revenue. And that's what the banks have done, right? So the banks here, they anchor on, a particular product, and then they'll try and cross sell you. So, I think there was a question here with respect to, this whole 1% mortgage rate. It's actually in that statement from our HSBC that says our anchor is the mortgage, right? So this could be a loss leader for them. We don't know what their pricing economics are. We don't know what their margins are on that product, but they know that if we can capture a mortgage from a client, we can then introduce 5 or 6 other products onto this family or household, and that's where they're going to make their money. So I think fintechs need to start to shift their mindsets towards not just a one product type solution, but start to integrate other product lines where they can start to increase that per client lifetime value.
Absolutely.
John, I was going to add one other thing to the comments, particularly what Marcus and I were talking about, where our focus was largely on residential real estate. I think it's worth parsing out the different asset classes within real estate, and their performance has been very different. I think the clear winners throughout COVID have been residential real estate and industrial real estate. Retail properties have probably taken the largest hit. And there's other ones that have done well, like cell towers, data centers, like healthcare has done well. Those are kind of the winners. When I talk about stability, I'd say I'd probably carve out retail. I think they've been hit the hardest. And there's a couple where the jury's kind of still out to see how the recovery goes. And that would be like hotel properties would be one. Office space would be another. Like early on during COVID, office space has been relatively stable, but it was largely buoyed because a lot of the contracts within that space are long term. There's a lot of subleases that are taking place, so there's more supply coming to the market. There's more options for consumers on that side, so they have more flexibility. So don't know where that market's going to go. But as far as industrial real estate and particularly residential real estate has been very stable, and expect that to continue.
Picking up on that thread and the question that you touched on there, Mohammed, from the audience, and kind of, I guess, a question to all three of you really, but perhaps Marcus and Mike in particular, is kind of how you think the vaccine release early next year, and once it gets rolled out, is going to affect single and multiple family residential real estate in BC Lower Mainland and the GTA area.
Yeah, if you want to, well, I'll jump in. So essentially, like with the vaccine, like everyone was kind of holding their breath with initially when COVID kind of was introduced into the market and into the economy, and like as the government started printing money, and then everyone, especially in residential, well, across all asset classes, they're like, what is going to be the impact on how many people can pay their mortgage or pay their rent to the landlord, and what's going to happen with the collections on that, and vacancy, if they're going to increase or spike. And as Mike alluded to, like different asset classes were affected differently, right? Like the retail side of things, if it's a grocery anchored place, like grocery stores, people, those are super in demand, so those are doing very well. But I mean, focusing specifically on the residential side, we didn't see like a big spike in vacancy rates or in rent collections, going to the point that was made before about residential real estate being, we use that terminology, recession resistant or recession resilient, right? And that's kind of looking at prior trends on what happened in the last recession, right? Like through 08, like there was no spike in Canadian real estate in vacancy rates. And all that to kind of say is there wasn't a huge blip in the radar when this kind of was introduced into the economy. People were still paying their rents, still, they need a roof over their head, especially in a time like this when there was like shelter in place and you're not allowed to go anywhere. This is more important than ever, especially when you see people, I mean, looking at majority of people on this call, most people are in a home office or working from home. So that kind of makes it more important than ever. So that's speaking kind of exclusively to the rental market, which like basically we didn't see a big impact on collection rates or vacancy rates. If a vaccine is introduced, I mean, all the better. That will basically start bringing things back to normalcy eventually. But essentially, because there wasn't a big drop in rent collections or a huge spike in vacancy rate, like for whatever impact that did happen, we can expect that to potentially start being corrected over time, because for those people that say this vaccine actually works, and I don't even know all the details on it, but if we can kind of start getting back to normalcy and people that may have been laid off or underemployed or unemployed can now get back to their work, then those people that may have been struggling to pay their rent or had to move in with a family member, then you can kind of see them get back to normalcy and maybe go back out on their own or rent a place. So the minor effects that we did see in residential would hopefully start to be corrected. That being said, like with the housing market, values have stayed strong. It's kind of crazy in the Lower Mainland and in BC and in probably in the Toronto area as well. Like prices were like staying strong, they were going up, and people kept buying, right? Like it was kind of a shock where it's like, where are these people getting this money from if people are quote unquote like potentially underemployed or have been laid off? But there was so much pent up demand, and that kind of speaks to the supply and demand factors of real estate. Like there's so many people in Canada already, and there's not enough housing for them, right? There's that inequilibrium of the supply of rental properties and houses and the demand that's kind of pent up for them. So basically, still people are demanding and bidding prices up on homes, and kind of, I've talked to a realtor friend of mine who's just like, yeah, like there's, you'll put out a property on the market and it's bid up over asking price, like just like that. Like, so that's kind of why we see, especially in the rental side of things, we see a great opportunity to be in the rental market, because people need a roof over their head. There's so many people, there's growing population, there's not enough rental properties on the market already to keep up with that demand. That's what kind of gives us that security, knowing that, hey, we hold a rental property. Well, you're probably going to have a pretty, safe time going out and renting that out and keeping high occupancy. So I don't see a huge impact on things overall, because there wasn't even a huge impact on residential on the rental side of things, multifamily for, when the pandemic was kind of introduced into the economy. But any other thoughts on that, Mike?
Yeah, so there's a lot of factors, and I think across the board, there being a vaccine would be a hugely bullish indicator for the vast majority of the economy. A few nuances with that, I think the expectation is that interest rates remain at historic lows for the foreseeable future, so that's a very positive for real estate. The cost of borrowing money has never been cheaper, and that's why some people kind of surprised with how well real estate has done as far as the asset prices, largely to do with interest rates. There's a lot of other factors too. I'd say immigration being a big one. Once that opens up a little bit, I think so much of Canada's economy is based on immigration. So, and same with, that's where a lot of the demand comes for real estate, and we have a lot of supply coming online in Canada, particularly in Toronto, but consistently demand has outstripped that supply. I expect that to continue. And the third main piece that I would think of would be inflation. I think that inflation is going to be probably a little bit above the historic averages that we've seen, and real estate does really well in a high inflation environment. So I think those combinations, certainly from our perspective, we're very bullish on real estate in Canada. And I think with the vaccine in particular, it'd be very bullish, but there's other factors around that I think look very good as well.
That's I think that's a pretty thorough covering sort of the supply and demand side of stuff. And I want to pick up there on another question that I saw come in terms of not just the supply and demand overall, but kind of like the geographic dispersion. So the question is about, I touched on this in the start, but there's a much publicized move away from downtown. Do you guys really see that that's actually happening? A city's still a safe investment is the audience question, or are they maybe undervalued right now and it's a good time to kind of get in there while before the prices go back up?
Yeah, I'll take the first crack at that one. I think there's maybe a little bit, in my view, of a misconception about this flight from the cities. I think the way I kind of view it is there's an uptick in demand outside city centers, but still, I think it's hard to beat the demand for city centers, and particularly once COVID or past COVID, I think that demand's going to quickly return. And even I'd say the trough of demand within city centers is still pretty strong, from both the demand for the assets themselves and the prices, and then also looking at the vacancy rates for renters and the cap rates on those properties and stuff like that. So I think that generally, yes, I expect that there to be sort of a reversion back a little bit close to where things were, but I don't think there was that big a departure. At least I think the conception that a lot of investors have is that there's a more exaggerated change versus what I think actually has been the case.
Absolutely, and it kind of, I guess we're all a bit guilty with the press of getting a bit carried away with kind of hyperbolic stories, like the death of the office, the death of sort of city centre or whatever it is, whereas it's probably a much longer trend than that, and kind of like Marcus touched on, sort of up and down flips in the short term don't affect the long term per se. Again, that leads me on to another question from the audience, which is, this demand for real estate is not going anywhere in the long term, and it's a great asset. But in terms of accessibility, how would the panel say that a middle income person enters this market when they live in one of these hot markets? And I think that kind of brings me to one of the topics that we were going to discuss anyway, which is in terms of what the barriers to entry are. So maybe if I could start with you, Mohammed, sort of asking a little bit about real estate is clearly an attractive investment opportunity. It's not going anywhere. It should be for everyone, but do you see that there are barriers to entry and getting involved? Is it something that's knowledge-based, financial, as per the question, regulatory, something else?
Yeah, I think there are multiple barriers depending on the situation of an individual, right? I can speak to the Canadian Muslims here that have religious barriers to entry because they're not allowed to transact on they're not allowed to enter transactions that pay or receive interest, right? So if you're trying to buy a property that you can't pay for fully in cash, well, how do you enter into a transaction that's not interest based, right? And so that's what we've solved for here at Menzel, is to create a profit based transaction model that is not only asset based or asset backed, but complies with their religious beliefs. When it comes to, and I can give you an exact example, which probably relates to this individual's question is, imagine you have a subset of a population that's been saving along the way, saying that my only way to get into this market is to purchase a house fully in cash, right? And your savings rate is not keeping up with the growth rate, right, of the market, especially in metropolitan cities where you're getting double-digit returns sometimes on an annual basis. Like if you look at the last 10 years, real estate in the GTA has grown by at least 100%, right, in terms of the asset appreciation. And so, how do you solve for that problem, right? So, so we've solved for kind of saying, well, yeah, you have 30, 40, 50% down payment. We can now enter into this transaction to basically fulfill the remaining balance that you're requiring. For individuals that say, well, I don't have any religious concerns and I can go to a bank and I'm okay with entering into those types of transactions, I think it really comes down to the habits that need to be created as a potential investor or even saver, right? I always tell people you can't be an investor until you're a saver, right? And you need to start to instill those habits and save a portion of your net income on a monthly or biweekly basis and get in that habit, but allow that money to grow for you, right? It's going to be a lot slower if you don't have it invested for somewhere and working for you on behalf, right? So any one of these platforms that you see in front of you, whether it be the Menzel Mortgage Fund or Westbow Capital or Willow, these are the opportunities that we're providing to individuals to say, like, in the meantime, if you can't get into the market and actually live in something for yourself that you own, that you have ownership of, you can then just invest it in something in the meantime in a similar asset class to get you a decent rate of return. And then when the time comes, you'll have that money available, and hopefully the bank is willing to supplement kind of what your down payment is with the difference on a mortgage. The other thing too is, we're now starting to see some regulations around easing those issues, right? So before, we never had this, so-called stress test in the marketplace. And that immediately dropped kind of that rule of thumb of saying whatever your income is, you can afford 5 times in a mortgage down to 4 times in a mortgage. And now CMHC, which is the Canada Mortgage Housing Corporation, is coming on saying, well, we're going to shift it from 4 to 4.5, right? To ease kind of that stress test rule. So hopefully these things will help first-time home buyers get into the marketplace. There really is a push on accessibility and financial inclusion, I can tell you, from CMHC with respect to particular programs to get certain demographic groups, certain medium to lower income type groups get into homeownership. Because what does that do at the end of the day? It frees up low income housing, right, for those that are really in need, right? And low income housing are those rental units, apartment buildings that you see across the city that are just so much demand but not enough supply, right? So they're trying to shift, right, some of those populations to get into home ownership, free up some of that supply, and get those that are super in need or even more in need than the ones that were in there to participate in those types of properties.
John, if I can jump on that one, I feel like, it lines up perfectly with what we do at Willow. And I think the question is sort of, how do people get involved in real estate? I'd like to throw the plug, like the takeaway is Willow is the answer. What we're trying to do is elevate real estate investing for everyone and also remove the barriers. And one of the reasons that we exist is the barriers to investing in real estate are so high. And personally, I think that real estate by its nature hasn't really been incentivized to innovate, and that's partly why those barriers currently exist. But with Willow, we're creating a real estate exchange where people can invest as little as $100, and we streamline that process. People don't need to become a landlord to become a real estate investor. And to the previous point raised, the money is then pegged to a particular real estate market if that's what an investor wants to do. So if they're looking to eventually buy a place in Toronto, they have a certain amount of capital they want to allocate to that market. With Willow, you can be selective about what properties you buy, so you can invest in a specific property. You can build your own custom portfolio of properties. And so you can get that direct exposure. So the risk and return is isolated to those individual properties. And there's a lot of different sort of avenues we could take about how do people do this. We could have a conversation about the exempt market and from a regulatory perspective, what does that look like? And there's a lot of pioneering that we're doing to make that possible. So that somebody can share in the ownership of an investment property with somebody else. We're calling that prop sharing. So that's where people can come to our platform and own an investment property with other people, and that reduces the cost for them. And it's worth noting as well, as far as like what the current barriers are, transaction fees are very, very high in real estate. They need to come down. It seems like really inefficient, and we can do better. 5% transaction fees within a real estate purchase is almost something worth celebrating. 7% plus is more common when you factor in real estate agents on the buy and sell side, plus legal fees and all the other home inspections and stuff like that. So it really adds up. So the cost is really high. It's unnecessarily high. And so what we're trying to do is eliminate those barriers and allow people to invest starting with as little as $100. And so we're going to be we just completed our front footer campaign. Well, it's going to be formally closing, I guess, sometime this week, but we have raised our full 1.33 million. We expect to be live early next year. So for people interested in getting started in real estate or elevating that investment experience, we hope to capture your eyes on that front.
Where can they find out more, Mike? They can go to your website, right? Because you say
willow.ca. And if you want to stay up to date, you can join our wait list, and we'll keep you updated.
Absolutely, yeah. Very, very exciting times for Willow.
And John, I kind of
go ahead.
well, you might even be leading on to it on the next question here, but it kind of tags along with what everything's being said here about kind of barriers of entry. I remember when we were kind of chatting about earlier on in this, before this webinar, you were kind of talking about, well, you want to really discuss who is this for? Like, who is real estate for? Is it good for everyone, right? And I think there was already a question on there, like, how does a middle income or somebody get into the market with all these barriers of entry that we've already discussed? Mike has already alluded to like the different opportunities that are with Willow. And I think all of us on this call are really trying to eliminate those barriers of entry to help people get into the real estate, because, first thing we started off with this call is talked about all the benefits, right? And that's why you see like it's a kind of a snowball effect where the people that are in it can realize all those benefits and get the snowball moving. It's going downhill. And then because the ability to go and buy a property and then you refinance, pull out, buy another property, like you can snowball your wealth very quickly. And that's why getting in that, eliminating those barriers of entry is so important, why we kind of strive to do that. So kind of the main thing is like, well, who is it for? Well, really, I would say everybody, and that's why we exist, is basically to help people into the market from across different types of investors, all income levels. So, I mean, starting at the what we'd call the retail investor, from like the person that might be just right out of college, doesn't have enough for a down payment, doesn't have enough to buy into a market or into a home themselves, or buy an investment property, right? Well, what are they going to do? Like save up for the next 10 years if possible, and hopefully buy in one day or partner with somebody? Well, I mean, that's going to take a long time. And what's already been discussed is like, you need your wealth working for you over time, because that's what's going to actually create more compounded growth over time. So, I mean, for that person just entering the job market, I mean, what we've done, I'll kind of talk about our offering a little bit. We've basically made it so that you can invest as little as $6,000 into our fund, which then buys into a diversified portfolio of multifamily real estate. So, I mean, and multifamily is kind of proven to be have like some economies of scale, because there's more cash flow, there's more tenants, more diversified, your risk exposure, because with one property, if you own one property yourself, you're then holding on to that property, and one person goes out, one tenant, you got 100% vacancy. Well, if you're in a multifamily, 100 units, one person moves out, you still have 99% occupancy, right? So those are some of the economies of scale that we look to introduce to investors that join us in that process. But I mean, for you to go and say, I'm going to go get that same type of risk adjusted return on an investment and try to do that by myself, like you're not going to get that same type of investment. You're going to try to go out on your own and buy a 100-unit apartment building. Well, probably not feasible unless you're Donald Trump's kid or something like that, right? So things like that. And then basically it allows these retail investors to basically like, hey, I've saved up $6,000, $10,000 or whatever. I can now enter the market and invest into a diversified portfolio, start building my wealth, and maybe continue on that path. Or maybe one day they're like, hey, I want to buy a property of my own. It's whatever they kind of prefer, but that allows them to enter the market. They may not have the ability to go get the loan for themselves. They don't have enough cash for a down payment. Well, that's kind of how we go and eliminate that barrier to entry. But also, like, I'm going to explain on the flip side of things as well. Even if you had all the cash available and you're like, well, I could go buy this property on my own and manage it myself. Well, say you have 100, 200 grand sitting in the bank and you're like, well, I just want to go and buy, a duplex or 1 units or a quad or something like that, and do that and just manage it myself. It's right across town in my city here, and I can go manage it and it should be no problem. Well, then you're a higher earning professional, say you're, a lawyer, an accountant, a doctor or whatever, like you're kind of focused on your day job, right? Like then you're going out and buying a property, then you become a landlord, you become a property manager in effect. And now you're dealing with, okay, your work during the day, and then you're potentially taking tenant calls, you're collecting rent, you're doing all these different things, a pipe bursts, and then you're dealing with a leak, and you didn't account for that expense, and now you got to go figure out how to pay for it or fix it, and tenants calling you on Christmas Eve or something like that. So these are like the things that that you would potentially be exposed to if you go do it by yourself. Not to say that you can't go and do that. It's just kind of comes down to what the investor prefers to do. I mean, what we'd be calling an active investor wants to go into the market. You can get a great return. But on the flip side of things, what we can appeal to that high net worth accredited investor that basically is like, hey, I'm really good at what I do. I'm a doctor. Like, I don't want to, be taking patients and thinking on my free time about how I got to go and drive over and, talk to my tenant or do an eviction or something like that. I just want to focus on my day job, earn as high income as I can, and then just go invest passively into an opportunity and get similar risk adjusted returns. And basically, I've kind of heard this called like an armchair investor. Like, well, you kind of can sit back on your couch and not really worry about what's going on because you're investing with a professional manager who this is their full-time job is worrying about optimizing the rents, the incomes, the collections, and all those different aspects of running a property, because it's a business. And by relying on a professional manager to do that, you can then kind of focus on the things that you want to do instead of trying to work extra hours late into the night to try to do it yourself. You can just focus on your day job, and then kind of go to in the evenings and hang out with your family, do the things that are meaningful to you, and not have that extra stress on you. So that's kind of where we see real estate really appeals to everyone. I mean, there's the active, there's the passive side, and really you can fit into different categories in how we kind of go up, and the opportunities for the panelists on this call, how we like to create opportunities and eliminate those barriers of entry so anyone can really get involved in the market.
I think you hit the nail on the head there, Marcus, that it's obviously about kind of democratizing access to what is clearly an exciting and sort of interesting and sort of, going to deliver you good returns over the long term type of investment, and also making it easy and straightforward, which also brings me on to, I guess, the last point I wanted to cover before we wrap up, which is in terms of resources and additional information. So I think all three of you have done a great job of really kind of explaining what this is, what you should look out for, and how to do it. But I guess my question to you, and if maybe I could start off with you, Mohammed, is where would you point people who want to learn a little bit more about investing in real estate? What resources do you like or recommend? They've kind of, you've wet their whistle, they're interested in it now. After this call, where should they go and check out more info?
Yeah, like I like factual information. So I love subscribing to Better Dwelling. I'm sure all of you guys have heard of it. They're always bringing out reports that allow you to better understand kind of the market dynamics from a macroeconomic and a microeconomic perspective of what's happening in the marketplace. And then, then there's just general research about kind of the players that are out there, right? Like we hear a lot of these guys that are in the States, like there's the Zillows of the world, or Zolos and Unison and all these types of people. But now we're seeing these players being created in Canada, which is fantastic, because the opportunity in real estate has always been for kind of that accredited investor type person, people with disposable income, high, earning potential. And now it's being democratized to be accessible to the retail consumer, through the likes of Willow, Menzel, and even Westbow. So I think we would be a very good starting point, just because we're three different kind of asset classes, I would say, three different mandates. And then you can start to expand your horizon from there and just better understand kind of what is out there and what meets your personal risk appetite. Because, some people may look at investing in physical real estate through a fund as a lot more riskier than investing in the cash flows of that real estate through a mortgage fund, right? So there's, and always understand kind of the criteria of or the philosophy of those fund managers, right? The people running the show. You may want to have a conversation with them to better understand, like, what is your philosophy? How do you buy? What do you guys look for? Are you looking for undervalued stuff? Are you guys the guys that take something renovated and then flip it to realize the gains? There's so many aspects to it. So do your research. This is probably a great starting point, especially with this panel that we have going on. And subscription to Better Dwelling, or the like of these types of email lists usually will help frame your mind, and so you can start to look at these trends and where they're going.
Yeah, I actually didn't know about Better Dwelling myself, so I've made a note, and I will certainly sign up. What about you, Mike? Where would you recommend people take a look for more information after the session?
I think it depends on a little bit what they're looking for. So one of my go-tos is Collier's reports. They provide quarterly updates on different aspects of the real estate market. It's a little bit, some people might find it a little bit technical, a little bit data heavy. To me, I like that. So I look to those kind of reports, I guess, for the most part myself. But it really depend on the investor. I'd say a starting point, if somebody's interested in getting involved in real estate, like the first thing I'd recommend is look at your overall portfolio. We've talked about diversification multiple times in different ways, like diversifying within real estate. I think my personal sort of thought is a lot of people are underweight in real estate in their overall portfolio, including their stocks and stuff like that, and their ownership in their own home if they have one and stuff like that. So I'd say look at your overall portfolio, and then when it comes to honing in on exactly where you want to expand within real estate, I guess it depends on whether you're looking to make that initial investment. If you're looking to buy a house, your research is going to be different than if you're trying to understand the overall trends. But I'd say, to give like one concrete reference, would be Collier's.
Fantastic. And Marcus, what about you to wrap up? What would you recommend for more info and advice for people?
Yeah, and I've heard that concept of, there's so many resources out there, and I could probably give so many, but when there's too many options, then you just don't even know where to start. So I'll try to keep it brief here. But obviously, all of us, we do have, well, I think Mike, you said you wrapped up your campaign, but most of us do have campaign pages on Front Funder. You can kind of check out more details on our particular offerings, all the details there. Ours is called Westbow Capital, if you want to learn more about that. But in general, if you kind of want to learn just more, it's important just to understand real estate in general, how you can, different ways to invest and different things like that. And there's a lot of great resources out there. One of them that's really good for kind of introducing you to the world of real estate is Bigger Pockets. If people haven't heard of that already, if you type into a question in Google on real estate, usually, a lot of times Bigger Pockets, a forum will come up in regards to that, question, because there's people on there you can ask questions about real estate. There's people, experts on there that will give you actual advice. So checking out their forums. They also have a great podcast, Bigger Pockets podcast. And then, a last plug here. I actually did start a podcast of my own in this last year here. It's called Wealth Builders Real Estate Investing Podcast on all podcasting apps there. But really just focused mainly on the multifamily side of things, kind of demystifying that, kind of talking about the ins and outs of multifamily real estate, and talk to a lot of experts on that side of things. So check out a lot of resources out there, and just get educated, figure out what the best strategy is for you.
And for your podcast, Marcus, people can just Google it and it shows up. I guess it's on all the major channels, right?
Yeah. You can Google it, Wealth Builders Real Estate Investing Podcast. It'll pop up on, Apple, Google, whatever you listen to on.
Fantastic. Well, I'm afraid that's actually all we have time for today, but I really hope that you all found the session useful, and do let us know via email if you have any other questions that we didn't cover in the session, and we'll do our best to answer via email. And as touched on during the session, although Willow's campaign has already completed, I would like to remind you all that Wespo and Manzel both have live campaigns on FrontFunder and do so for the next week or so. So if you'd like to find out more or learn more, please do head over to our website and check them out on the investment opportunities page. But other than that, a huge thank you to Mike, Marcus, and Mohammed for joining me today. I really appreciate you giving up your time and chatting with us.
Thank you so much, John. Really appreciate it, and happy to be on this panel with such esteemed individuals in the real estate space.
Indeed.
Thanks, John. And thanks for tuning in, everybody.
Thanks for having us on, and thanks again, everyone, for attending.
Exactly, yeah. And as the panel said, thanks very much, especially to all of you at home for tuning in. We all wish you all the very best for the holidays, and we'll be back with more events in early 2021. So stay tuned. Thanks a lot. Bye.